You're scrolling through Reddit or TikTok and see two camps. The buy the dip thrill seekers claiming crypto stocks are about to explode, and the calm, disciplined dollar-cost averaging investors telling you patience is the real alpha. So which one actually wins? Which strategy consistently outperforms in the long run? And more importantly, what fits you? 3 years ago, I found myself torn. I'd saved up $10,000 in my brokerage account and faced a crossroad. Do I risk it all on dips when markets crash? Or do I split it into reliable chunks and invest slowly? I'll never forget the night before my first dip buying binge. I was jittery, watching prices tick by the minute, questioning everything. And when I finally clicked buy, markets fell further. I panicked. I lost money. And I realized I'd gambled, not invested. That's the danger of chasing dips without a plan. But let's rewind and look at dollar cost averaging, DCA, as the pros call it. I set up a $500 monthly transfer into an index fund. No thinking, no emotions, no timing. Every month, rain or shine, I bought shares at average prices over time. The beauty? The math was on my side. I didn't need to catch lows because I was building steadily. I beat myself less, gained sense of control, and watched compounding kick in. So here we are, two strategies on the table, DCA versus buy the dip. Which is better? Which is safer? Which actually builds wealth? Buckle up, because in this video, we're unpacking the data, the mistakes, the emotional pitfalls, and revealing which one truly wins, and for who. DCA is simple. Divide your total investment into equal amounts and invest on a fixed schedule, weekly, bi-weekly, monthly. Over time, you average out the highs and lows. You're not guessing the top or trying to time the bottom. You're smoothing volatility. You're disciplined. You're in the game, and you stay in it. By contrast, buy the dip means camping on your phone for corrections, 10%, 15%, maybe 20% down. When the bloodbath hits, you dive in, hoping for rebounds. That strategy can work if you buy low enough and sell high. But guess what? Markets crash for a reason, and sometimes they fall past your too high fear point. Emotional hunger sets in. You question your timing. You buy late, or you don't buy at all. Each approach has pros and cons. Let's examine both, starting with DCA. Primary strength? It removes emotional interference. Markets cycle. So do emotions, fear, hope, FOMO. DCA ignores all that. You install autopilot. You send money into the market at regular intervals, no matter what. Over time, that leads to a lower average cost per share compared to lump sum on random days. Historically, markets tend to rise over decades. So DCA allows you to ride that trend without psychological sabotage. But people hate to admit it. DCA feels boring. It doesn't promise big wins in a week. It doesn't let you brag. I bought 50% down. It's slow. It's steady. And that feels unsatisfying to thrill-driven brains. Now let's flip to buy the dip. The appeal? It feels smart. It feels aggressive. It plays into the hero fantasy. You're buying opportunity when others are scared. You're fearless. You're outperforming. And if you nail a few dips, high fives. Viral tweets follow. But the truth? Timing the market is a losing battle for most. Let's do the math. Scoop A invests $10,000 via DCA over 10 months, $1,000 monthly. Average price ends up somewhere between high and low. Portfolio grows steadily. Scoop B holds $10,000 in cash, waiting for dips. Misses the chance to invest early. Markets go sideways or up. Cash stagnates. Eventually a correction hits, but portfolio value is now higher. Even after buying the dip, total invested capital earns less than Scoop A's steady approach. And that happens more than people acknowledge, because markets spend far more time trending upward than falling sharply. Even if Scoop B catches a perfect low and invests, there's a second trap. What if corrections never come? Or come slowly? What about opportunity cost? Money sitting idle, earning nothing. And what about the anxiety? Watching cash lose buying power while you wait. That pressure leads to mistakes, panic investments, emotional exits, poor timing. So here's reality. If you want stress-free investing, avoid emotional risk, and let compounding do the work. Go DCA. If you want to take tactical swings, dissect corrections, and ride rebounds by the dip. But only if you have discipline, timing skills, and the temperament to hold through the drawdown. Let me tell you about Anna and Brian. Anna chose DCA. She invested $500 per month into a diversified ETF. She missed dips, but didn't panic. She grew $6,000 in her first year, $18,000 by end of third year. Her net worth included steady market gains plus discipline. Brian went dip hunting. He waited for crashes. Markets lingered. He parked cash in money markets. He froze on bigger drops. He missed rebounds. He jumped in late. He got some wins, but overall underperformed Anna after fees and lost opportunity cost. But maybe he got lucky? Maybe he caught a few spikes and beat her. Maybe. But is that lottery? That's trading, not investing. And it requires active analysis, active management, emotional strength. It's not passive. So which strategy is right for you? If you're beginner, time-strapped, or future-oriented, you need DCA. Set it, forget it went over decades. If you're experienced, confident, analytical, and have a strong cash buffer, dip buying can be profitable, but only if you accept that you may lose too. What if you combined? Hybrid. Put 80% on DCA and keep 20% in an opportunity fund deployed into dips. If no real dips come, let that fund work elsewhere or accumulate. It gives you both discipline and optionality. Now, let's be clear. Institutions don't try to time tops and bottoms. They use dollar-cost strategies and strategic rebalancing. They know half-guessing kills results, and they copy DCA across billions. They influence market trends, not crash themselves chasing dips. So what should you do? Funding a retirement account? Use DCA. Trying to optimize additional funds for crypto dips? Keep that part separate. Treat it like speculation, not core investing. Let me leave you with this. You have to ask yourself not which strategy is better, but which strategy fits me. Are you comfortable watching cash sit idle? Do you understand your own triggers and risk tolerance? Do you have the time and knowledge to analyze corrections? Most people don't, but lots say they do, until they're staring at losses they never planned for. Here's your challenge. Open your investment platform now. Choose an amount you can live with. Schedule DCA transfers. Then create a separate dip bucket, maybe 10 to 20% of your portfolio. Use that bucket only if you see a 10 to 15% drawdown in your core holdings. And keep it disciplined. Don't reach for arbitrage unless conditions are favorable. No impulse buys. If this video helped you land on strategy, do 3 things. Like it to show support, comment which path you're choosing, and subscribe because I'll be sharing advanced hybrid strategies, portfolio rebalancing techniques, and risk control next week. Want real-time dip alerts and spreadsheet trackers? Pin this video and follow along. Because investing isn't a sprint. It's a marathon, and flexibility beats rigidity. Win with discipline, hedge with smarts, and build wealth that lasts, regardless of market noise. Drop a comment, hit like, hit subscribe, and let's grow smarter together.